Welcome back to another deep dive. Today we're unpacking a situation that I think perfectly captures the torture of being an active investor in this market.
Mhm.
It's that feeling, where you look at a chart and your technical brain just screams, run away, this is breaking down.
But your fundamental brain is looking at the valuation and saying,
Mm.
hold on, this is the opportunity of a lifetime.
Exactly.
It's the central paradox, right? Market timing versus time in the market. And usually you have to pick a lane.
Right.
But the analysis we have today, it's called short-term pain for long-term gain. And it's basically asking us to straddle both. It's looking specifically at SoFi, but really this could apply to the whole high-growth fintech space right now.
Oh, it really does. And what struck me about this source material is that it's not, a cheerleader for the stock. It's not one of those to-the-moon hype pieces.
Yep.
The analyst is looking straight at the technicals and just admitting, hey, the bears are firmly in the driver's seat.
Which is so refreshing, actually. It's a sober look at the price action. They're identifying a setup that is, objectively bearish in the short term.
Yeah.
But, and this is the key, they're using that bearish signal to plan a bullish entry. They're not panic selling. They're getting ready to buy.
So let's get into the weeds here. The source kicks off by looking at SoFi's daily chart, and it's painting a pretty clear picture. We're seeing a classic descending triangle pattern forming. And for anyone who's been watching the price action, this isn't subtle.
No, it's textbook. You've got this, rigid horizontal support line at the bottom.
Well, that 1850 to 1950 zone.
Right, where buyers have been stepping in. But then you look at the top of the pattern, every single time the stock tries to rally.
It gets swatted down.
And at a lower price than the time before.
The dreaded lower highs.
Lower highs are the market's way of telling you that demand is just exhausted.
Yeah.
The bulls are running out of ammo. A few weeks ago, maybe it rallied to 22. Then it only made it to 21, then 20. The sellers are just getting more aggressive.
It's pure compression. And usually when you compress a stock against a support level like that 1850 floor, something has to give.
Something's got to break.
And the source is pretty convinced the break is going to be to the downside.
Well, that's the probability play, right? When you see a descending triangle, the momentum is pressing down. The source even mentions that SoFi tried to break out of this pattern about a week ago.
Oh, yeah, that little fake out.
A little fake out to the upside, but it couldn't hold.
Yeah.
It just failed and fell right back into that zone.
And a failed breakout is often a really bad sign. It's like a signal that the next big move is a breakdown.
The analyst uses this phrase that really stuck with me. They said the stock is holding on by a thread above that support level.
It feels fragile.
It is fragile. And that brings us to the core of their short-term thesis. If you're sitting there hoping for some, V-shaped recovery tomorrow, the charts just aren't backing you up.
No.
The analyst says calling for a breakout right now wouldn't make sense. The path of least resistance is down.
Okay, so let's play that out, the breakdown scenario. If that thread snaps and we lose 1850, where do we land? Because this is where the whole analysis shifts.
Yeah, it shifts from the sky is falling to here's the buy zone.
And the source has a very specific target in mind, $17.
And that $17 level is critical. It's not just a random number they pull out of a hat.
No.
If you look back at the chart over the last year, $17 was a huge resistance level that the stock finally broke through.
Right. The old resistance becomes new support idea, polarity.
Precisely.
Yeah.
And there's also the gap fill theory at play here. When SoFi blasted up past 17, it likely left what's called a liquidity gap, a range where not a lot of shares actually traded.
Okay.
The market just has this weird habit of wanting to go back and fill those gaps. It's like it wants to test the structural integrity of that price level.
So the analyst sees a drop to 17 not as a disaster, but more like necessary technical housekeeping.
That's a great way to put it. It's a retest. And while the average retail investor might see a drop from 19 to 17 and totally panic,
Thinking the company's broken, yeah.
this analyst sees it as the chart resetting itself. They explicitly state, that is where I'm looking to pile in some more money.
Pile in, that's aggressive. They're not talking about just nibbling. They are waiting for that flush down to 17 to take a big position. But they also mention a second, deeper level, don't they, if 17 doesn't hold?
They do, $15. And that's what they call the accumulation zone.
Okay.
If market sentiment gets really ugly, maybe the whole S&P 500 takes a hit, SoFi could capitulate down to 15. But again, the analyst's reaction isn't fear. They say if it hits 15, I'll be buying even more.
It's a complete inversion of how most people react to seeing red on their screen. Most people buy when a stock is going up because it feels safe. This strategy requires you to buy when the stock looks like it's literally falling off a cliff.
Because you trust those structural levels at 17 and 15.
Uh-huh.
It's the difference between trading momentum and trading value. Momentum traders are selling right now. The chart is broken.
Right.
This analyst is waiting to be the one who buys the shares that those panicked momentum traders are dumping.
So what's the payoff? The source suggests that once this gap is filled, once we hit 17 or maybe even wick down to 15, the selling pressure should just be washed out.
That's the theory.
Mm-hmm.
The bears will have nothing left to sell. Once the weak hands are out and that gap is filled, the stock is primed for a reversal.
A big relief rally.
Yep. They use the phrase, it could get juicy from there.
I love that. But here's the thing. Context matters so much. SoFi isn't trading in a vacuum.
Not at all.
And this is where the source material gets really fascinating for me. They zoom out to explain why stocks like SoFi are getting beaten down while other parts of the market are hitting all-time highs.
This is the most important part of the deep dive, in my opinion.
I think so too.
You can stare at the SoFi chart all day, but if you don't get the macro flows, you're just missing the story.
Right.
The source points out that while growth stocks are bleeding, money has been flooding into defensive stocks. We're talking consumer staples.
Walmart. Coca-Cola, the boring stuff, the stuff you buy when you think the world is ending.
Exactly. But here's the kicker, and this is where the data gets kind of shocking. The source notes that some of these boring safety stocks, they're currently trading at 50 times earnings.
Okay, let's just pause on that for a second. 50 times earnings.
Yeah.
That's a multiple you usually see on a hyper-growth tech company that's doubling revenue every year.
Yeah.
We're talking about companies that sell soda and groceries. How is that even possible?
It's a crowded trade. It's what we call a safety bubble. Investors are so terrified of a recession or volatility that they've just piled into these names without looking at the price.
They're just looking for a place to hide.
But if you pay 50 times earnings for a company that's growing at maybe 2 or 3% a year, that's not safety.
No, that's a massive valuation risk. You're buying $1 of earnings for $50. That feels like the opposite of safe.
And that is the core argument of this whole analysis. The safe trade has become the risky trade because of the valuation. It's unsustainable.
It can't look like.
You can't have Walmart trading at a tech bubble multiple forever. At some point, the math has to matter.
So the source is basically predicting an unwind of this whole trade.
Yes. The prediction is that the short-term money that is hiding out in these defensive stocks is going to flood out soon.
Taking profit.
Taking profits. Institutional investors are going to look at their portfolios, realize they're massively overexposed to expensive staples, and they'll start selling.
And when that money leaves Walmart and Coke, it has to go somewhere.
That's the rotation. We talk about sector rotation all the time, but this is what it actually looks like. Fund managers sell what's become expensive, the defensive stocks, and they buy what's become cheap.
Growth stocks.
The source believes that capital is going to rotate right back into beaten-down names like SoFi.
That connects all the dots perfectly. So the reason SoFi is struggling at 1850 isn't just about SoFi's business.
Right.
It's because all the liquidity is currently sucked up by this safety bubble. But if that bubble bursts or even just springs a leak, that liquidity flows back to growth, and that's what fuels the juicy rally the analyst is expecting.
Exactly. It's a flow of funds argument. You're betting on mean reversion. You're betting that the market will eventually wake up and realize it's absurd to pay 50 times for soda while paying so much less for high-growth fintech.
So if you put this all together into a coherent strategy, it seems like the source is advocating for extreme patience followed by really decisive action.
That's the mantra. Short-term bearish, long-term bullish.
Right.
And executing that is incredibly difficult psychologically. The analyst advises ignoring quarterly or yearly benchmarks if you have a long-term mentality.
Which is so easy to say on a, deep dive like this. But when you open your brokerage app and you see your portfolio down 4% on the day because SoFi broke support, that long-term mentality evaporates pretty fast for most people.
It does. Fear takes over. And that's why the analyst emphasizes having a plan before the drop happens. If you decide today, while the stock is at 19, that you are a buyer at 17.
Then when it hits 17, you're not panicking.
You're executing. It changes the narrative in your head. Instead of, oh no, I'm losing money, it becomes, great, my limit order just got filled.
Right.
The analyst says they have no doubt SoFi will eventually recover, and that conviction allows them to treat the price drop as an opportunity, not a threat.
They're playing sniper.
That's a good way to put it.
They're not chasing the stock up. They're just waiting for it to come right into their crosshairs at 17 and 15.
I really like that sniper analogy. It implies you aren't just spraying bullets, not just buying every single dip blindly. You have very specific structural levels where you believe the value is undeniable.
And it also implies discipline. A sniper waits. If the stock never hits 17, if it just miraculously rallies from here, the analyst might miss the trade. And they seem to be okay with that.
But if it does hit their target, they don't hesitate.
Let's talk about the risk here for a second, though. What if the safety bubble bursts, but the money doesn't rotate into growth? What if it just goes to cash?
Sure.
Because if the market really crashes, usually everything goes down together, at least for a while.
That is the risk. In a true liquidity crisis, correlations go to 1. Everything gets sold. And I think that's why that $15 level is mentioned. That's the, in case of emergency, break glass floor.
Got it.
But the source's argument is that eventually, capital has to seek returns. Cash yields are falling as rates get cut. Bonds are boring. If you want growth, you have to buy growth stocks.
So even if there's a flush where everything sells off, the rebound should favor the assets that are actually growing, not the ones that are just expensive safety blankets.
That's the logic. You'd rather hold the stock that's already down 40% and cheap than the stock that's up 40% and historically expensive.
So to recap the battle plan from this analysis, step 1. Accept the technical reality. The chart is a descending triangle. Bears are winning right now. Step 2, watch for the breakdown below 1850. Don't fight it.
Right.
Step 3, target the gap fill at $17 for your first major entry.
And step 4, keep some powder dry for 15 just in case the broader market throws a tantrum.
And step 5, wait.
Wait for the rotation. Wait for the market to wake up to the insanity of paying 50 times earnings for consumer staples.
It sounds so clean when you lay it out like that, but I want to circle back to something we touched on because I think it's the most provocative idea in this whole thing.
The safety bubble.
Yeah, the safety bubble. I mean, think about the average investor. You're told your whole life, if you're worried, buy blue chips. Buy the companies you know.
Buy the dividend aristocrats.
Right. And this source is saying that right now, doing exactly what you were taught to do is the most dangerous thing you can possibly do.
It's a classic case of what feels emotionally safe being financially risky. Crowd psychology creates these distortions. When everyone runs to one side of the
boat tips over.
And right now, everyone is on the safety side of the boat.
And the risky side, the growth side, is empty, or at least it's a lot less crowded.
Which, ironically, probably makes it safer in terms of valuation. If SOFI is already beaten down to 17, how much more downside is really there compared to a stock at an all-time high valuation?
And that is the question to leave our listeners with today. We all like to think we're contrarian. We all like to think we can buy when others are fearful. But if this analysis plays out and the market starts to rotate, are you actually willing to sell the safe stock that's been going up every day to buy the risky stock that's been going down?
It takes a stomach of steel.
Yeah.
But history shows that's usually where the alpha is generated.
A stomach of steel and a plan written down on paper. Keep your eyes on $17, keep your eyes on 15, and let's see if this triangle resolves the way the bears hope, or if the bulls have a surprise in store. Thanks for diving in with us.
My pleasure.
We'll catch you on the next deep dive.